So before we dive into questions, I want to quickly provide the audience with some background on the speakers for context, and then give an outline of where our conversation's headed. All of our panelists have extensive backgrounds in the U.S. lodging market. Evan is principal of a leading hospitality valuation and advisory firm. Will is responsible for evaluating, executing new development projects at a hotel-focused private equity firm with about 100 hotels in the portfolio. Joe focuses on acquisitions and development for an owner-operator with 150 hotels in the U.S. The portfolios are both geographically diverse across the U.S. and have a good mix of full and select, but probably lean more select serve. And both portfolios skew heavy Hilton Marriott. Second, on where we are headed, the focus today will be deals, development, and lending. So let's just jump right in. And to level set and frame it up, the backdrop here is the U.S. lodging market's about 5.6 million rooms. We were delivering about 10,000 rooms a month, so 120,000 rooms a year. We would close about 20,000 rooms a year for net openings of 100,000. That was just under 2% supply growth. And this is kind of where we were operating, call it 17, 18, 19. That was the formula. Today, we're opening about 5,000 to 6,000 rooms a month. So annualizing 60,000 to 70,000 rooms a year. So the key question we're looking to eventually answer through the conversation is how long before we get back to opening that 120,000 rooms a year here in the U.S., if not more. So Joe, I want to start by getting your perspective here. There's clearly some holdups that are contributing to the softer openings, the softer rooms under construction. Talk about what big picture, what you're seeing out there, and why we're not at that annualized 120,000 clip right now.
Yeah, sure. Thanks for having us, Ben. Couple of thoughts on this. One is you do kind of have to look at this market by market. I know we say that about a lot of things, but like we're buying a hotel in Chattanooga downtown right now, and I would tell you that market's probably going to experience like 10 to 15% supply growth over the next like 2 or 3 years. So some of these like Smile States, Dallas, Phoenix, like Florida, haven't really experienced much of a slowdown. But all that being said, I personally think you're probably 3 or 4 years before, like nationally, you're back at that 120,000 type number. One is financing. It's hard on acquisitions. It's even harder on development. Debt's probably SOFR plus 500 today, in my opinion, for 65-ish% construction debt. Based on where SOFR is heading, that basically means you're paying 10%. That's quite expensive. 2 is supply chain. Getting materials here is extremely challenging. This wasn't even a ground up development, but I know guys that just did a AC conversion down in the Orlando area of Florida. They thought they could do it in 9 months. They ripped a building down to the studs. Took them 24 months from start to finish. And I think like, while it used to take a Hampton 13 months, you're pretty much double that timeline right now. And then 3 is just kind of cost. It's still very expensive. People don't really know where costs are going. Some people are kind of like hitting pause because they think, you know, costs will either plateau or start to like come down a little bit. So I think, you know, there's macro uncertainty from like a financial and just kind of like general economic sentiment. But I think also people are, you know, taking a pause and I'd say a wait and see approach to see what happens in terms of like the actual construction costs. But
okay,
those are some of my thoughts.
Yeah, Joe, that was really helpful. You know, providing some of the headwinds. Evan, I want to bring you into the conversation here and get your perspective and maybe kind of rank order some of these headwinds. There's, you know, supply chain, which is leading to longer construction timelines. There's costs of material and labor. There's the move in rates, and then there's the macro uncertainty. How do you kind of rank order those in terms of what's the biggest holdup?
Sure. Thanks, Vince. Thanks again for having us. So I actually happen to agree with a lot of things that Joe said, which is something I usually don't say in public. I don't want to make his head get too big. But Joe happens to be spot on. I personally think both on the construction for new supply as well as, frankly, on the operational side in terms of what folks are doing with their hotels from a future-looking perspective, capital markets, interest rates are probably the largest issue right now. To Joe's point, SOFR plus 500. If you're lucky, you get up to 65% debt, and if you're lucky, you get about 10% interest rates on that. And And then when you take that and you combine it with the longer lead times, in other words, instead of having to take 10, 12% debt for, call it 13 to 18 months, it's 25 to 36 months. Not only, do the interest rates hit you harder, but they also hit you doubly as hard because the supply chain is pushing you out. So I would say capital markets / interest rates would be my number one issue in terms of headwinds on the supply side. The second would be the supply chain, just difficulty in getting what you want and also difficulty in getting it when you want it. The third, I would say, would be material costs because they've fluctuated so much. For instance, lumber is back to pre-COVID, but things like steel are not. So, and then the lead time on getting these things and then the shipping and all that. So, material costs are definitely substantive, especially when you see a lot of select service hotels selling, call it for $160, $180 a key, and to build them would cost you, again, I'm being overly generalizing because we're looking at the U.S. on a macro level, say it's $200 to $220. So, there's more arbitrage, if you will, in buying not only in-place cash flow, now you don't have the risk of development, and you're building to a larger number than a fully renovated asset would be otherwise. So that's sort of preventing folks from putting that shovel in the ground. They're continuing forward. I would say labor, in my view, is probably the least issue. The labor market, by and large, from an operational perspective as well as from a construction perspective, is nearing its 2019 levels. It's not at, but I would say that that's probably the least of your concerns as it relates to things like interest rates, supply chain, and material costs when it comes to development of new hotels. I think there's two other factors also that I think we should be considering. One of them is sort of net supply. So a lot of hotels have converted, especially in a lot of urban markets, to other uses. So you're seeing that sort of create a lower amount of actual rooms in supply. And on top of that, a lot more home sharing rooms or units, if you will, are being added to supply. And I don't know if that's being counted, and I don't think that's being counted by folks like STR, et cetera, when they talk about supply. So when we talk about supply, we're talking about hotel rooms, but there are also other things. First of all, closed hotel rooms reopening, closed hotel rooms being permanently removed, as well as the home sharing side of things that need to be considered when looking at overall supply numbers.
That's a really good point, Evan, on the home sharing thing, and we've done some work on that as well. So, Will, I want to bring you into the conversation here. You've heard Joe and Evan's take. You look at rooms under construction right now, we're at 150,000-ish, down from over 200,000 pre-COVID. So my question for you is, which way are those rooms under construction headed in the next 6 months in light of all these factors? Are we hanging out at 150? Are we falling, are we rising? What's your expectation in the next 6 months? And then I know you guys are a bit of a contrarian here with everything you got going on the development side, so maybe share that perspective as well.
Yeah, absolutely. Thanks, Vince, and thanks for letting me join the conversation. I started doing the math to give you an answer, and then I realized that you kind of kicked off the call doing the math for me. We had, historically net 100,000 rooms added per year, and now we're going to add half of that. It's kind of the direction we're feeding that right now on the development side, right? We're putting one more room under construction, and we've got two that are opening, so to speak, if you look at it the way you laid it out. And so with that, I think we just continue to see the numbers go down. To your point, we are a bit the contrarian. I think it's nice when you are, you're the owner and you're the operator. You're not, you can kind of be self-contained through the process and really focus on, some of these changing our investment horizons and realizing that, whereas as a merchant developer, you might build it, ramp it, sell it. You may never even ramp it. You might just go sell it. Joe, I'll call you for that. Those are the paths we could go down. But for us, we're saying, why don't we ramp this and just get a stabilized yield and make a really strong coupon? And, that's something that we've been able to do both in, we find the strong markets where there's, where we think it's durable. We, generate a lot of cash flow from where we put the assets. And I think the other one, and I don't think we're even talking about on this call much today, but it's the opportunity zone angle as well. It changes your perspective when you think about development, when you say, boy, I literally have to own this for 10 years to realize the big benefit to my investors. That gives us a lot more confidence in kind of the longer term hold, despite headwinds from construction costs, from the debt capital markets, et cetera. That's kind of loosely how we feel about it. And I know as we talk a little more today, we'll get into some of the more specifics, but at a high level, I think that we're a ways away from getting back to 210,000 rooms under construction. To Joe's point, market by market, really, really high in some markets, the Chattanoogas, the Nashvilles, pick your market, but other places just doesn't make a whole lot of sense.
So let's to put a number on it. In the great financial crisis, December 07 was the peak, 210,000 rooms. We hit a low of 50,000 rooms in like June of 2011. So a pretty significant contraction, fell off 160K. We've fallen off 60K thus far. Like, do you think that 150 is on its way to 100, 125? Does it just hang out here at 150? Like, when we're sitting in March of 23, what do you think that number is?
I think it's maybe more in the I would say 100. We might slip down into 5 digits, but 100 is probably a good estimate. I mean, that said, it's when do we reach the full ramp? It might not be till 26 again. So maybe we get down to 100 and then we just start creeping up.
Okay.
Yeah.
So Joe,
it's a good point. Well, it's like there's a lot of like if you look at like lodging econometrics, like supply pipeline in totality, like when you look at like projects in planning stages that aren't yet under construction, like in places like Dallas or even at the national level, like that's not off like that much. But I think like when they're just not under construction because I think of the challenges like going on in the world around us. It's simply expensive. It's hard to find financing and it's hard to get the materials. I don't think I agree with Evan in that like the interest rate and the financing is probably the biggest like piece of the puzzle that you're trying to solve for right now. I hope it gets better at year end. I'm always the optimist, being in like the investments business. I don't think it gets that much better over the next like 3 or 4 months. So like I don't see that rooms under construction like improving like at all. I kind of agree with Will. I think it's going to continue to struggle for the next like 6 to 9 months until it starts to rebound, maybe like the latter half of next year until like 2024. But I don't see that improving much in the current environment. My 2 cents.
Evan?
I generally agree. Yeah, I generally agree with the sentiment, not to sort of pile on and not anything original. Our sister firm, LARC, presents new supply data going forward based on a number of different sources. And essentially, this may be helpful. In 2021, new supply as a percent of existing stock went up by 5%. So if you're using, Vince, if you're using your, call it 5.6 million rooms today, that's a pretty big number. That includes reopenings as well. So let's just be clear. Our 2022 forecast is about 2.5%. So that's about 125,000 rooms. Again, that includes reopenings as well. Most of the temporarily closed hotels open by the end of 21, but there's a few stragglers into 2022. And then 23 and 24, are about between 1 and 1.5% each year in terms of new supply, which is on the lower end. 1% being around that 55,000 mark in 2024, and a lot of that has to do with supply chain, and a lot of that now has to do with the increase in the interest rate. So generally agree that we'll probably stay below 100,000 for the next couple of years, but then thereafter, just like all kind of economic cycles, supply chain should be worked out. Capital markets hopefully are, let's call them normalized. I don't know about stabilized, more normalized, whatever that means, right? Whether it costs you SOFR plus 3 or SOFR plus 600, whatever it is, will be more sort of an expectation rather than a shock and normal. And therefore, people will say, okay, well, this is what it costs to build. Am I building or not? As opposed to like, let me wait this out or let me see where the markets go. So, we're not really expecting more of a normalization until almost 2025, I would say, in terms of new supply.
Got it. So
Yeah.
let's dig more into the cost to build. And Will, can you put some math around this and just kind of, I know it can vary by market, but a typical select serve Hilton Marriott product today versus 2019, what are you paying per room?
I thought about that. If I had a budget $1,000 a room now, so that's a little more than 30%, 33%, right? And that's probably a good round estimate. Be interested in some of the projects. I know Joe and I were talking.
Hey, Will. You broke up a little bit there. I heard something.
Sorry about that.
30%. But could you clarify?
Yeah, sorry about that. Yeah, so 30% roundly is the number that I'd say we see with some of the started back in 2019, that now we're seeing it, you know, we're now finally getting final pricing. Projects that we just shelved and decided to pick back up, call it 30% increase from 150 to 200,000 a key, or from 175 to 220 a key. That's what we're experiencing. And, you know, I think it's the biggest issue for us. We're a number of our markets, we've been fortunate in that the costs have been commensurate with the increases in performance in those markets. For instance, we opened a Homewood Suites in Destin back in March of 2022. Our costs were up a ton. Destin also had incredible growth over the past few years, and we, just as an aside, we are not as worried about contraction in those beach markets, because we know that in addition to this rise that's happened there, we're also the best product in the market because we're the newest thing around in that select service set. But where we sit today, when we watch those cost increases, the biggest issue we really have is that we get intermediate pricing from our general contractors, but we're not feeling confidence in the number until the day we break ground. And that's a really hard environment to be in. I think, to Evan's point about working with lenders, to go to them and give your best estimate of a budget when you really don't know until the last minute. And that doesn't really create a lot of confidence in anybody. So, you know, we continue to work on as we think about managing these costs, carrying really conservative numbers early on, but it's just hard to tell. And in some projects, 30% might have ended up being 20. Others, the 30% ended up being 50.
That makes sense. Joe, why don't you weigh in here on build costs today and where you think they're headed versus pre-COVID levels, and then where you think they're headed in the next 6 months?
Yeah. Look, I think Will's spot on. I think it's 30%. Look, like, case in point, like, I'm a big believer in Dallas. I just think, like, long term, it's a phenomenal investment market to invest in. We've probably bought 10 hotels there over the last 2 years, and like, we're buying a Courtyard kind of like just to the west of kind of like downtown. And like, look, I know the guys built that for $140 a key because they had everything like cost out and they bought it in 2019. And we have like very frank conversations with them in their DC, and to do that hotel again, this is 4-story stick, pretty much as plain vanilla as it gets. You're easily talking 180. And I hear that like pretty much consistently across the board. Residents in, you know, bigger rooms, more amenities with the kitchens, like, maybe it's not 140, it was 150 or 160. And like, now you can't do one basically for less than 200,000 a key. And like, Dallas is like the easiest place arguably in the world to like build in. But like, that's the actual cost. Now, because like lumber is so expensive, I'm seeing a lot of guys just say, well, fuck it. If I'm going to spend that much money, I might as well build like, you know, 5 or 6 story like concrete and steel, like a more solid structure, because they think they're going to get paid for it on the exit. So like, while they could have done it a lot cheaper, they decide to like spend a little bit more money. So now they're doing something like kind of like beyond like the normal prototype. So maybe they're spending like 40% more. But that's just kind of my high level view.
That's really.
And Vince, what was the second part of your question?
6 months from now, is it still up 30%, or are we headed to 35, 40? Does it ease to 25 ahead? Where are we headed?
The only one who can answer that question is Powell, and hopefully he curtails inflation so that it's not going to 35 or 40%. But I can tell you that I don't think inflation is transitory. I think it is going to 40%. It's only a matter of time. And because of that, to Will's point, like, you really have to like pick your markets like very wisely if you're a developer. Like, you need to be building and investing in markets that are going to outpace inflation. Otherwise, you're just going to end up upside down, and that's not a good place to be.
I think, hey Vince, by the way, one thing that I think about is, or what I've been telling people around the shop is, we're continuing to increase, but just at a decreasing rate. So that's kind of the best that we can hope for around here.
Okay. So Evan, I want to get your perspective here. You mentioned kind of rates being the biggest issue earlier. That makes debt and equity more expensive. When you combine that move in rates with the elevated construction costs and delays, Talk a little bit about how this impacts the decision to buy versus build for hotel investors today.
Yeah, listen, we're on the phone with probably two of the most prolific hotel investors today, between Joe and Will. I would imagine the two of them combined since 2020 have purchased, I would venture, other than maybe one other player in the market, probably the most hotels in some capacity, either on the debt or on the equity side. But I will wade in here. The interest rate side is affecting both. Well, let me address equity first. There still seems to be an exorbitant amount of equity on the sidelines waiting to be waiting to be invested, and quote unquote investable capital. And a lot of it's chasing real estate because the markets are upside down as well, probably even more so than the real estate market. Things like tech, things like retail. I mean, these are all sort of unknown quantities, and the hospitality market's been recovering fairly well, again, market by market, of course, but overall, it's been a really nice recovery for the hospitality market. 2023 anticipating RevPAR back to 19 levels, and then 2022, RevPAR back. 2023 by the middle of the year, probably back to EBITDA levels. So again, there's a lot of equity out there, and when you think about it, two things. Number one, the hotel space is still offering better equity levered and unlevered returns than other assets of real estate, and more safety than other asset classes of investable opportunities. The leverage aspect is sort of endemic, if you will, across all sectors of the economy. So I think that a lot of the equity still continues to chase hospitality deals and wants to invest in hospitality deals. You hear numbers all the time, the big private equity firms. Maybe some of them pressed a little bit of pause on the hotel side, but generally speaking, there seems to be a lot of equity capital available. Now, the question is, does equity move their target returns? I was speaking to one developer at the lodging conference most recently in Phoenix a few weeks back, and they were saying, I said, so with the rising costs of construction, how are you presenting this to your investors? They said, we have a group of family office and long-term investors. There's a large development platform within the hospitality space, and we used to underwrite to a 20, and now we're underwriting to a 16 or 17. It was that simple, meaning you just have to adjust your returns. There's just no way to get there, right? Operations can only go do so much. So on the equity side, again, I think there's a good amount of capital, and I think the equity may be adjusting their return expectations, if not overtly, certainly, implicitly, and it's a good place to go. On the debt side, I definitely think that there's definitely a push towards existing assets. The expensive nature of the debt is definitely pushing folks towards the existing assets. However, that being said, with what Joe and Will were saying in terms of the cost of these assets to build, I mean, it's also increasing the cost of these assets to purchase, right? I mean, it used to be a 5% debt load, is now a 10% interest rate. I mean, I'll give you an example on one deal we were looking at. An asset has a $10 million NOI in 2021 and will in 2022. And because of the floating rate nature of their debt, they went from $6 million in debt service to 10. So they literally eliminated their entire cash flow available after debt service. So when you think about things like that, it sort of impacts the decisions to buy, because I mean the buyer's market for the most part has also contracted dramatically. So I don't know ultimately if the debt markets are pushing more folks to buy versus develop. I think they're just pushing more folks to press pause or negotiate heavier if they are in the buying or the development market.
I want to add one thing, Evan. You said one thing that I think is so compelling that I feel like I need to call it out. Like the one developer you spoke with that said their returns went from a 20 to a 16, gross IRR. The funny thing is, that's 400 bits. We all do that math. But the 20 was probably in a 0% interest rate environment. The 16 is in a 400 plus basis points interest rate environment. So when you look at the real return, I would argue they're taking an 800 basis points lower return on that project, which is, when you think about it, quite a fundamental change in expectations.
I couldn't agree with you more. The math didn't add up for me either, but that I'm simply reporting on sort of what they said. And to your point, Joe, I mean, not that I'm sure ever do this, obviously, but a lot of times folks underwrite to something, and they're sort of thinking in the back of their mind that, hey, if I return 300 basis points less, it's still then, better than having money sit in the bank account and actually losing capital because of how high inflation is, right? I mean, and Joe, I think you mentioned inflation a moment ago. I mean, you can't discount that. too much. I mean, that to me, that's the biggest spot on point right now where, inflation is still high. Yes, it's not increasing as much as it was, or it's maybe decreasing slightly, but it's still 8, 9, 10% above where it was, and that's just creating, impact throughout the economy. So, I mean, obviously later on we'll talk about the deal side, but.
Yeah. Vince, I think the bigger thing here in terms of it's not like buy versus build. I think the bigger conversation that I'm having like a lot more conversations about is, do I want to play in equity, preferred, or like do I actually just want to do the debt? Because if you're doing loans at SOFR plus 500, like Peachtree does, this is 80, 90% of their business at Stonehill. They're doing debt at SOFR plus 650. SOFR is 400 basis points, probably going to 5. They collect a point in, they probably get a point out. They get other like admin fees along the way. They're making probably a 15% levered return, arguably without even getting out of bed, right?
If not more.
I told you that's the question.
I said if not more, and on top of that, Joe, to your point, they're making that, and they're at a 65% leverage point instead of at a 100% leverage point on the equity side, right? So much better risk-adjusted return. We're seeing a lot of that. I mean, we're seeing a lot of folks say exactly, sort of junk the equity side, say I'll give you prep all day long because I'll go up to 75% of the stack because I believe in the value, and I'm happy to sort of take it back or take control at that level as well.
Yeah, and look, I think it's a very good business for this point in the cycle. Like you're getting paid, like spreads are high. Like spreads typically compress, like in periods of like higher interest rates, right? Like they'll go from like 350 to 250. That never really happened. They went from 350 to 500 to 650 because of all the uncertainty in the world. So like I think that will change when people like know where this like economy is headed. But right now, I think there's a tremendous opportunity in the debt space.
Hey, by the way, guys, thank you for the free advertising. And yes, and Evan, to your point, sometimes it may be even better than the return target. But joking aside with that, I just want to add on one other point because prep was just said. One thing we benefit from on our platform is we can pretty much go any direction we want when we're investing, and that's where we do have sponsors who maybe are starting to feel that debt crunch, where even with a preferred position, we can give them some relief from that, and then just so in the moment solve for them their issue of their interest rate creeping up on their cap rate, while at the same time just setting on the back end whether we're picking interest or we're a minimum IRR or something like that. Those are other ways that we're trying to make solutions in the moment to take the heat off that still hit our investment targets.
So, Will, let's keep going here. You obviously have a lending division, but you also are borrowing money and putting a lot of new development into the ground. So, talk a little bit about like where's construction debt for you right now versus maybe 90 days ago, and the point that Evan and Joe are making is like, hey, if you can just lend and make 15% plus, that's pretty good. What's the incentive to develop if returns aren't that great and you could just lend into it?
No, absolutely. So, I think on the first one, just in terms of how we're borrowing and what we're seeing, let's take a normal environment. When we are in times of, after a crash, say after the great financial crisis, interest rates went to zero, spreads went out because there was uncertainty. The world started getting better, spreads started coming in. Kind of that natural cycle that can happen. We're totally beyond that now, where we do have interest rates increasing, and we don't have spreads compressing to accommodate that to keep kind of a consistent interest rate. So to Evan's client, Evan's partner who went from $6 million of debt service to $10 million of debt service, that's just the world that we're in and what we're dealing with. And maybe the bigger issue is not only is that happening, but what was before, SOFR 450 to borrow on at 65%, it's still SOFR 450, but it's 60 or 55. So now you're just dealing with much more expensive debt on a relative basis. One thing that I think, it benefits our platform, it benefits Joe's, it benefits some folks and kind of creates a haves and have-nots world, is that we have great relationships with banks that allows us to focus more on our construction costs being the feasibility issue than the lending costs being the feasibility issue. and not everybody has that. I think builders want to build, and they're going to find a way to do it. But if they can't complete the capital stack, it's just not going to happen. So that's where Stonehill is, and our debt platform is having its moment right now, is that capital has dried up. But for our equity investment platform, we're able to continue to rely on our relationship lenders to get these deals set up. And I think to contrast that, Vince, with 90 days ago, I think that's really addressed with the leverage points. So I'm not sure pricing has changed materially, but I do think leverage has come down. That's the biggest thing with the senior lenders.
Joe, talk to us a little bit about the terms that you're seeing out there in terms of debt availability, where debt providers are, quoting deals today versus 3-6 months ago, and where we're at from a loan-to-value perspective.
Yeah, I hate to be all doom and gloom, but I think the short answer is debt's just not available today. I feel like heading into year end, it's always a particularly hard time to get debt because, a lot of lenders have already kind of met their quotas for a year. Like they've got like the deals that they want to close by year end and they're kind of like done. And it's always a little bit harder to get someone to bite. And I think right now it's like borderline impossible unless you have kind of like the relationships that Will kind of talked about. So because it's hard to get people to bite, I would tell you like that SOFR plus 350 or 400 spread at 65% is firmly now in that like SOFR plus 550 to 650 kind of range. So the spread's probably up by 200 basis points and the base rate's up by 200 basis points, give or take, depending upon how long back you want to go. So like your debt's probably 400 basis points more expensive than it was. And that makes it very, very challenging to get deals done. And like if you're looking for debt, I think you're calling debt funds because the CMBS markets, I would argue, are effectively shut down right now. The large money center banks like B of A, Wells Fargo, they've been quiet for like the better part of the last like 6 months, I would say, since like the middle of the year. I've even heard a lot of stories about term sheets getting pulled from those banks, which is like pretty shocking considering who they are and how big their balance sheets are. So I think you're talking to debt funds, your local kind of like regional relationship lenders. That's where you're getting quotes from.
So Evan,
hey,
help
Joe,
us.
Joe, to your point on just briefly, Joe, the debt funds, the challenge they have, they're probably levered up too, and they're having to get creative about how they can actually finance their pieces as they go to lend this money out.
Yep, I agree. They all got repo lines, right? Yeah.
Thanks. So Evan, I want you to weigh in here. I'm trying to balance that. Joe says it's really hard to find debt, and then you're saying, hey, you can make a 15% levered return without getting out of bed. Sounds pretty good. Like, why isn't there more people lining up to kind of provide debt into what looks like a pretty good risk-adjusted return?
It's a really good question. Candidly, Vince, I've asked myself that question quite a few times. I mean, one of my most simplistic ideas, and from speaking to me quite a few times, I'm not the smartest guy in the room. I mean, I don't understand why somebody wouldn't just go out there with a $2 billion in equity, go out and lend it in the hotel space, both for new construction as well as existing assets with cash flow, maybe just for existing assets with cash flow at 7.5%, 8%. I mean, they probably run out of that $2 billion within 6 months, and then use it all as equity, and then once capital markets return, lever it up, and ultimately provide a 12, 13, 14% return. And even if you lent that money out at a 55, 60% LTV, I mean, it sounds like super safe, and to get 13, 14% levered return on that, even over, let's say, like a 3 to 5 year hold, I mean, I think that makes a whole lot of sense. So candidly, I'm not entirely sure. Obviously, I can give you sort of the low-hanging fruit answers, which is that the capital markets are completely uncertain. They might continue to go up. They're not sure if hoteliers can make their debt service. We're also not sure what's happening on the recessionary side. I use the big R word, especially with inflation, as well as with the potential for a recession. How deep is the recession? When and how does it hit us? Does it affect corporate transient travels, already relatively slow return? and recovery? Does it affect corporate group, which has been doing really well and looking really good forecasting into end of 22, 23, and 24? Does that start getting affected? And ultimately, we've already seen a pullback in the leisure side of things as people return back to work, 3, 4, sometimes crazy people like myself, 5 days a week in the office. Do we see it being even further impacted? Because I'm hearing that leisure actually is being further impacted by potential recession, by the beginnings of layoffs in the marketplace. So when you put all that together, I think not only is there capital markets risk to the lending environment in the hospitality space, I think there's also perceived operational risk in the hotel markets. And just generally speaking, I think that lenders in general, as we all know, they're all about risk aversion, right? They're all about what could go wrong as opposed to like, wow, this is an opportunistic investment. Myself, Will, Joe, we all think opportunistically. Obviously, we think about the downside and we consider it and we underwrite it, but lenders primarily focus on it. And right now, it's sort of like, hey, why should we be putting out capital, even if it is really lucrative in an environment like this where we have so much uncertainty on the capital market side, so much uncertainty on the cost of both goods as well as construction side, potential labor issues, immigration issues, all this kind of stuff. And then on top of all that, there's a recessionary fear of a potential pullback in travel that could happen at any time. So why put out money in the hospitality sector? Let's just keep our powder dry and sort of, not have to worry about both that operational and capital markets risk. So I think that's why we're not seeing more. But to be candid, if I had people always ask that silly question at the end of a lot of hotel panels, what would you do with $1 billion? What would I do with $1 billion? I go lend it out at somewhere between 7-8% and then lever it up in a year from now. That's what I would do, or whenever the market's contract. Put it back up.
Yeah, and Evan, look, I totally agree, and I think like the often overlooked thing is like, even though there's equity like on the sidelines sitting there, like it is just as hard to find equity as it is debt today, right? Like if you're going out and you're raising a fund, and we've talked to a bunch of guys that have like kind of done that, like fundraising itself, finding the equity dollars is taking a lot longer than expected. And also we're talking about an opportunity in the debt space that like, who knows how long that lasts for? Maybe it lasts for 6 months, maybe it lasts for 12 months, maybe it lasts for 18 months. It typically takes about a year to raise a fund. So if you're raising a debt dedicated fund, you're probably going to miss like 95% of the opportunities if you're like starting from scratch today, right? So I think it's like a very hard thing. Like I get it. If you have money, maybe you could just kind of like pivot the strategy. But like if you're just thinking about getting in that business today, I think you're kind of like too late to the game.
Yeah.
Anyway. Yeah.
I agree.
So what are the brands doing, given all the factors you guys have addressed, to help stimulate interest, activity? Is there any more talk of lower fee ramp schedules, key money, or is it still just kind of pressuring folks with FOMO that, hey, if you don't have this true here, somebody else will? How have the brands acted in the last few months with all this going on?
I'll take a crack at that. You guys can weigh in too, but there's always the FOMO factor. They're always low. They'll levy that on you. So we've got that going on, but I do think we've seen from the major brands, I think they realize that there's a little bit of things like key money are maybe less of an incentive for you to pick them, and more just an element in making your deal work. Like that is a way to bridge a capital stack. That's a way to we had a project that we started on a couple of years ago, COVID shelved it, we brought it back, and we were able to go back to one of the brands and get them to provide supplemental key money after we even started, kind of in recognition of the fact that, 2 years ago when we started on the project, costs have now gone up 30%. They're kind of taking their piece of it too. A little maybe thank you for the loyalty, something like that. But I will say that for some, and we go back and forth depending on the deals, whereas typically we would prefer that fee relief. We just see more value in it over time, or on just royalty ramps. Sometimes it is nice to get that key money in the stack and have a quick return of capital to get your investors happy.
Joe, Evan, anything to add there?
The brands are notoriously difficult. They've still been difficult. We don't do as much ground up stuff. We've done more on like the conversion side. Like we'll take some independents and we'll make them, Marriott or Hilton soft brands or hard brands. I would tell you that the PIP scopes are as bad as they were in like 2019 when we were all complaining about it. Brands haven't stopped introducing new initiatives, whether it's this residence in kind of like chest in this closet concept or the open closet at the Hilton Garden Inn. Like they continue to like add more to these rooms, which makes it expensive. We don't really see the key money on the conversion side, and like they're very like unrealistic in terms of like timing expectations. Like this is not like a conversion, but like I can tell you, like whenever we get a Marriott PIP, it says like you have to do this PIP within 12 months. Do you know how hard it is to do a PIP within like 12 months of like closing a deal in today's environment? It's virtually impossible. So I think they're going to have to be a little bit more flexibility in the next 12 months if they want to hit kind of like their net unit growth targets. That's just my 2 cents, but we'll see what happens.
Okay. And, you know, the brands quote these pipelines. It's a mix of, you know, rooms in early planning, starts in the next 12 months, and then obviously under construction. So, Evan, your thoughts here, you know, rooms in early planning, like what does that really mean? How long can stuff linger in there? How delayed is early planning? Talk to us a little bit about that.
Yeah, I'm not sure exactly what those, I forget exactly what the definition of early planning versus, you know, in planning or, you know, under, you know, whatever it may be. I mean, early planning, I mean, I remember looking at the New York numbers years ago. I mean, things would linger in early planning for like years. So I don't recall exactly what the metric is for them to be removed from the early planning versus in construction or whatever it means. So I don't know. Most folks in the hotel industry don't take a very hard look at the in planning. They look at the under construction, look at the in planning really more so to see how it is changing from quarter to quarter, more so than what the actual numbers or their number of keys or what the percentages are. Right. I think that's more so what folks look at. And Will and Joe obviously can opine on that as well. I think it's the in construction that's really much more meaningful. That means, you know, you've got a shovel on the ground, the site and everything. Because something that's in planning, quite honestly, could be me and you, Vince, having a conversation saying like, oh, you know what, we should really be adding a hotel in Midtown Cleveland or something. And, you know, reporting it to somebody and them saying, oh, that sounds like a great idea. We got a hotel in planning in Midtown Cleveland of approximately 100 rooms. I mean, some of them are highly irrelevant. So I don't think people really pay too much attention to that.
Got it.
And I think that's Joe said it. You got to picture Joe rolling into Chattanooga and looking at the street corners, right? He's going to have that micro view, understanding, you know, he's going to really be able to see the pipeline. And I mean, by example, we're looking at a project in a market, a new construction deal where there is another similar flag that's in early planning, that's been in early planning for 10 years. So it's just about understanding those micro locations.
Yeah. Joe, can you weigh in here? And, you know, the other segment of the pipeline is, you know, starts in the next 12 months. Like, does that really mean started in the next 12 months, or is that just a target?
A couple comments. One is in terms of like, you know, in planning stages, I think that basically means they have a franchise application on their desk. Like someone says, hey, I want to build this here. To Evan's point, I wouldn't place too much stock in that. I don't think a lot of stuff that's supposed to start in the next 12 months starts in the next 12 months. I think that's pushed off to like, you know, 12 or 24 months. And then lastly, Vince, I think the way that brands are going to like get there to like their net unit opening is I think you're going to see more conversion brands. I just think that's like fundamentally in the pipeline from a lot of these guys. Like rumor has it that Hilton is rolling something out that's kind of like, I've heard rumors about like a WoodSpring Suites type competitor, which is a brand that's been like absolutely on fire like throughout COVID. And I've heard like Choice has like applications like out the wazoo. I've also heard rumors from Hilton about like a lower end kind of like conversion concept, like think like where all the 70s and 80s builds kind of like Hamptons go. I don't want to say to die, but I'll say to to die. I think that's how they're going to get there. Yeah, like I think that's how they get there because they know they're not going to get there with like actual like newly built constructed rooms. It's just not possible.
So what are they going to be converting from? Like, is there a big pool of eligible supply within, you know, say?
Yeah, look at like Keith, like if Hilton does this conversion thing, how many La Quintas are there out there? Like, if you were Highgate and you just bought the Core Point portfolio, and you have the opportunity to make that La Quinta a Hilton with very minimal PIP and like increase your RevPAR by probably like 15 or 20%, I think you do that tomorrow. I just think you do. I like look at all the Best Westerns, Best Western Pluses, Best Western Premier, which is a phenomenal concept, by the way. But like all those guys, I think sign up for this. I don't know why you wouldn't.
So it could be the choice
it's sort of a
window.
game change.
Go ahead, Evan.
Well, I think it was a game changer. If you guys remember, like, think about how many hotels that Marriott and Hilton lost because somebody just didn't want to be a Marriott, a Hilton, or a Hyatt, or a Western, or whatever it may be, right? So what they do, they created Autograph, they created Curio, they created Tapestry and Tribute, and to further striate and further differentiate within the soft branded sector. So to Joe's point, why would and why did all who lost out? Probably leading preferred, and then just the independent nature of those properties probably lost out, right? So a similar thing's going to happen here, where it's like, hey, I can become a lower tier Hilton, or I can become a lower tier Marriott. These folks are going to want to do that all day, every day, versus going into some of those other, I'll say, less efficient systems.
So why haven't they already, like, if it's that easy, why haven't they already converted, your Wyndham Choice, IHG, lower tier branded stuff into, the lower chain scale Hilton Marriott product? If it's a cheap PIP and immediate RevPAR bump, why hasn't this supply already converted?
Well, they really haven't. I mean, Evan, they really haven't had the option, right, until like potentially today, if this rumor is even true, which I think it is. But B, I think brands are a little bit of brand snobs, right? Like, look at their portfolios. It's Waldorf's and it's Ritz-Carlton's and it's JW, and they've kind of let a few other players like Choice kind of like play in the lower end space. And I think they now see the opportunity in the lower end space, like particularly coming out of COVID. And I just think it's been an area that they haven't really focused on. They've been focused on being the premium players in a kind of like, mid-scale, upper mid-scale, and upscale hotels. And now they're just expanding their portfolio.
Got it. Last piece of that pipeline, I know we've harped on it a lot, that rooms under construction piece. How long is stuff sitting under construction today versus, pre-COVID times?
I'm trying to think back to the timelines we were throwing around at the beginning of the call. But if we're going from a 12-month build to a 20-month build, the things are going to be in there for 70% longer. So It's just taking longer to get things done. However you slice it up, just sticking to a timeline is harder than it used to be.
Got it. All right. So we spent a lot of time on development. Let's finish today with some deals on more stabilized assets. You look at the recovery and RevPAR, really ADR driven, it's been quicker than initially thought. Hotel asset prices recovered a lot faster than thought. There really wasn't as much deals as people maybe or buyers were hoping in the midst of the pandemic. You see the W Nashville sell for $950 a key, setting a new record for the city. It's definitely a market by market story though, because you look at say the Sheraton in New York, which I think Host paid in 2006 about $740 million for, and just sold for $350 million. So it really depends on the market. But Evan, talk to us about kind of what you're seeing hotel prices today versus pre-pandemic levels.
Well, first things first, volume, while it looked good in sort of Q1, Q2, and even Q3 from a total volume perspective in the U.S. For major hotel sales, 10 million and over, you're definitely going to see a slowdown in Q4 given the capital markets. Capital markets really did not affect Q3 sales all that much because it sort of started being really affected in the end of Q2 into Q3, and a lot of those deals had already sort of locked in rates, and so a lot of those deals got done. I think you're going to see a massive slowdown in volume, and that goes on all ends of the sector. For portfolios, for sure, I think we've seen, there's a couple of larger portfolios that are under contract right now. I believe Mahul Patel has 40-something hotels under contract for about $300+ million, and a couple of others like that. But other than that, the day of the big portfolio, either on a recap or transaction, is sort of on hold for the moment. I wouldn't say it's certainly not dead. it's just on hold for the moment, where we saw a lot of that previously. And in terms, I'm sorry, so you asked me specifically about pricing, is that right?
Correct.
It's really tough to say. Interestingly, there's, in the hotel business, such a small world and really poorly kept secrets. I mean, there's, a portfolio out there right now of 3, uber luxury hotels, all branded, and, the seller is expecting and the brokers are expecting max proceeds. I'm talking about over $1 million to almost $3 million per key for these assets. And I think that is probably even higher than they would have sold for in 2019. I think the one thing we've seen since the pandemic started was that the luxury market, I'll call it the $1 million plus per key, even $2 million plus per key sales, have become way more prolific in the last 24 months than they ever were before. A lot of that has to do with sort of the flight to quality. These assets performed generally very well in the downturn and are still performing very well. A lot of the ADR gains, while they will abate over the next 12 to 18 months, they are not giving them all back. And so while occupancy may fall to where it was pre-COVID, a lot of the rate gains, ADR-wise, will stay intact, therefore buttressing and sort of bringing up the bottom lines. And so, again, I would say really it's sort of asset class by asset class. And I also think that, just given where inflation is, ADR hotels, generally speaking, did not drop ADR terribly and were able to recover it fairly quickly, even way before occupancy, for most hotels throughout the country. So in terms of pricing, I think you're seeing pricing that's kind of at or above 2019 levels on a per key basis. Obviously, it depends on the type of asset and depends on the market specifically. We see some markets that are achieving pricing that we never would have thought about, certainly 3-4 years ago, maybe not even 2 years ago. Markets that come to mind are places like Nashville. Dallas is having a great renaissance, as it were. But then you have places like San Francisco, New York, Chicago, where pricing is massively sort of depleted and depreciated for the, number one, because it's much harder to make money in those markets. And the downturn sort of showed that these markets are actually much more susceptible to the decline of corporate and corporate group. So it's been sort of interesting again. So I wouldn't say that pricing is up, down, or at. If you're looking at averages, you're probably at or above 2019 levels on a price per key basis. That being said, luxury much higher generally, also more sought after. To what Joe was saying a moment ago about extended stay. Extended stay performed exorbitantly well throughout the pandemic and continues to perform exorbitantly well. We're talking 85-95% occupancy on average for a lot of these economy extended stay and other forms of extended stay assets. As we all know, a lot of those are transitional housing supporting both the rate and the occupancy. A lot of these assets, I mean, we're talking about massive, amazing GOPs at these assets, 60+% for the most part. So highly profitable and trading at much lower cap rates. Historically, a lot of those assets traded, 9s and 10s, and nowadays are trading, certainly before the capital markets went up, somewhere between 6.5 and 7.5, which is kind of an incredible thing. And even today, they're trading below other similar limited or select service assets. So again, asset class specific, asset type specific, and also, asset type being, full service, or full service, suburban with meeting space versus select service, meaning, suburban right next door, much different. Right. So I know I'm going around a little bit.
No, overall, there's tons of variables.
Really,
I think
there's tons of variables, highly variable, but again, upper, it's interesting. The super upper and the super lower have traded on a much better price per key and a lower cap rates. Everything in the middle, that's much more dependent on new supply, CapEx requirements, which by the way are also up 30-40% in terms of those costs for CapEx and sort of exactly where they're situated.
Right. So Joe, why don't you weigh in here? And there's you guys have been buying hotels through the pandemic.
Yep.
Talk a little bit about where things are today, though, since July. Rates have taken off in July, and what's going on with the bid-ask spread.
Mm-hmm. I'll say like a couple like high-level things. One is like we talk a lot about per keys. I will tell you, like even us, like we're just a little less sensitive to per key than we used to be. Because like I feel like everything, like given where construction costs are and everything we've talked about on this call, construction costs are like out of control. Just because you can build something for $250 or $275 a key, which is what a lot of sellers tell me, that doesn't mean it's worth like $250 or $275 a key. It's almost like everything we're buying is at a massive discount. And it sounds great, and we can put it on the cover in an OM and tell all like the people about how we bought something at 50% off. But like, I think per keys, given where costs are a little less relevant. I'm very focused on cap rates, and I'm very focused on like investing in markets that are going to outpace inflation. I think inflation is here to stay. It's 8%. I don't know what the latest forecasts are, but I think it's forecasted to remain at 5% plus for pretty much the next 5 years. You need to be investing in markets where you fundamentally believe that each year for the next 5 years, you can increase rates in that like 4 to 5% ballpark. Otherwise, like that cap rate where maybe you're buying something at an 8.5 today and you think it's going to go to a 9 or 9.5, that 8.5 is going to, 7.5 or 8. And like, again, you're just kind of like upside down on your investment. So that's kind of what we're focused on, which means like we're drawn to, the smile states like many other people. I think the bid-ask spread is very real. I think the big private equity firm buyers are waiting for material discounts. I would say that's like 10% plus relative to where we were a couple months ago. I think we're probably off like 5%, maybe like a little bit more than that. Just, like it's just math. Like if you calculate what like 200 basis points on your loan is for the next like 2 or 3 years while rates are elevated, you generally end up in like a 5 to 10% like discount at 65% leverage. So that's kind of the range I think we're in. I don't think they're going to fall materially more than that, just because, like, quite frankly, like when we went through COVID, hotels went from like 100 to kind of like 80% of like value, when revenue went from like 100 to 0. And like what we're talking about now, I don't think is like an element of distress anywhere near on that magnitude. So I think if you start to approach kind of that like 10% off type number, you get a lot of the equity coming back into the markets on the buy side, and that kind of holds pricing up. So just like, COVID, people were waiting for kind of like 50% off kind of deals. I think you see people waiting for that now, but it's not going to happen, and stuff is going to trade a lot tighter than we all think.
So, Will, I want to get your perspective here, and something that came up earlier in the conversation around PIPs, and brands have been pretty lax on it for the last couple of years. And now it sounds like they're getting a little bit more particular. Somebody mentioned that even sometimes unrealistic of, hey, you need to do a PIP in the next 12 months. But how is their stance towards owners on getting them to reinvest, today versus 6 months ago? And then what does this mean for assets potentially coming up for sale?
Yeah, no, that's a great question, Vince. And, it's something we're living today. I mean, as you hit on, through the pandemic, the brands got lax and the owners needed it. The challenge now is, one thing with that is you go spend your FF&E reserves on debt service, then you got to go renovate. I think if Joe or I are wearing our acquisitions hat, we're watching owners who used up their FF&E reserve to pay debt service, and they've got investors who are just tapped out. They don't want to put any more money in. That's, I think, where we're going to see some opportunity, because then the owner's got to come out of pocket to pay for the renovation more so than he used to. Doesn't really have the option to refinance to get the capital to do the renovation, just because the debt markets aren't there, unless they can find Evan at 7%, which I'm going to call him after this call and try and get a bunch of that money. I'm
still looking for the 1.99. Still looking for the 1.99 billion of my $2 billion raise. So we'll talk after. Yeah.
All right, good. Yeah, let me know when you chipped away at it. But I think, all joking aside with that, the brands for sure are. I would say two sides. One, the brands are saying, all right, guys, like, that's enough. Fix your assets. We gave you the relief. And, I mean, Joe can point to his portfolio and probably say the same thing, but I've been in some of our hotels where we got 2 years relief from doing the renovations, and it is outsized how much more work we're going to need to do because of how hard those things got ridden, especially in markets that maybe performed better over the past 2 years, where, sure, maybe we would have renovated if we could have, but they were full of people. Either way, these hotels are now pretty beat up, and it's not only does it cost more to renovate, but the scope just got bigger too.
Yeah, I will say one thing. This PIP thing is, PIPs are out of control. Like, it used to cost like $20,000 a key to do like a 14-year refresh at a Hilton Garden Inn. I think that's probably $35,000 or $40,000 a key now. And like, when I say full renovation, I mean soft goods and case goods. I think buyers are so scared of having to execute the PIP. You don't know how much it's going to cost because we're in a high inflation environment and construction costs are absurd. You don't know how long it's going to take you to get supplies. you don't know how long it's going to take to do the project period, which means like displacement is a major concern. Like you are taking such a fundamental discount as a seller if you have one of those projects right now, that I would tell you to do everything in your power to go get that PIP done yourself and then take the asset out to market. Because people are going to haircut you so much for having to deal with that headache that's what I'm telling people to do. And I'm seeing a lot of busted deals where sellers like, oh, the PIP is, 25 or 30,000 a key. And buyers are saying like, look, I'm gonna have to do this in 2 or 3 years. Like 25 or 30,000 a key could be 40 or 45,000 a key. So, I don't really see eye to eye with you on that. And it's PIPs are a major issue. So if you got a big one coming due, I would tell you to do it and then, monetize the asset because they're a major headwind.
Great. Well, appreciate those thoughts, Joe. We'll wrap it up here in light of everybody's schedule. I know we've got a lot to take care of here on a Friday afternoon before the weekend. Evan, Joe, Will, really appreciate you guys being on the call today. Thanks for all of your expert insight.
Pleasure. Thanks for the opportunity, Vince.
Thanks, Vince.
Sure thing. And for our audience, I hope you found the conversation helpful, thought-provoking, and keep an eye out for other Travel Juice Live talks we'll be hosting in the near future. Hope everyone has a nice weekend.
Thank you, ladies and gentlemen. This concludes